Hi, everyone. It's Brad Thomas and Nick Ward. Welcome back to the Wide Moat Show. In case you missed it, last week we discussed how Albert Einstein referred to the eighth wonder of the world as the power of compounding. If you missed that episode, make sure you watch it as Nick and I discuss proven ways to grow your wealth during turbulent times just like these. Now, speaking of turbulent times, Nick, I understand you were traveling this weekend.
Yeah, I was. And I'm going to go ahead and throw in allegedly with that Einstein comment. People that watched last week know that Brad and I, we're disagreeing on that a little bit, but that's okay. I was in Washington, D.C. this weekend, our nation's capital. My wife was running in the USA 10-miler championships on Sunday. I didn't realize, I was just trying to take the kids to the dinosaur museum to look at the art museum, etc. There was a pretty massive protest in D.C. this weekend. I wasn't aware. I'm buried in the markets. I don't really pay attention to politics, apparently as much as I should. But I think there's like 20,000 people there. So, we saw a bunch of signs and, I was pretty amazed. You saw a lot of bad words, anti-Trump, anti-Musk signs, a bunch of randomness. But Brad, I tell you what, there was a lot of people that had the 401k on their signs. They were upset. So people are paying attention to this market downfall here.
Absolutely. And look, I think we're now in one of the most volatile markets that I've seen almost since I got out of college. I mean, I think 1987 was the first 3-day scorecard we've had, and we're approaching that right now in terms of the sell-off we've seen over the last 3 days. So
yeah, I think it was five. I saw this morning on CNBC, 5.7 trillion off the S&P just Thursday and Friday last week. Yeah. So yeah, that's right.
This is why I'm so excited about our topic today, because I think this could be one of the most important topics of all that I write about and talk about. And, here at Wide Moat Research, we focus on principal preservation. We're not chasing yield. We're not chasing the next shiny toy. We're not chasing crypto. We are focused on fundamentals and buying high quality and recommending high quality companies. Charlie Munger once said, the first rule of compounding is to never interrupt it unnecessarily. Munger always highlighted the benefits of long-term investment strategies and the avoidance of actions that could disrupt the growth process. Now, that's what we're going to be talking about today, is the growth process and how dividends sometimes interrupt that process of compounding. Now, in my Reach for Dummies book, I explain a sucker yield. For those who aren't familiar with a sucker yield, here's the definition. A REIT that yields 10% or higher almost always means, with some exceptions, that investors perceive very low growth or even worse, a potential dividend cut ahead. It's tempting to act on that kind of percentage, but it usually ends up badly. Hence the term sucker yield. It makes a sucker out of the buyer. It's simply too good to be true. Now, if a stock seems to pay out a dividend that's exceptionally high, investors should look even harder at the payment behind that dividend than they would otherwise. It's important to recognize that there are two ways to make money in the stock market: capital appreciation and dividends. But when the dividend gets hit, the capital appreciation almost always gets affected too. So it's not a lose-lose situation. That's why investors should always focus on dividend safety and to always pay close attention to the payout ratio.
Yeah, just to be clear, so dividend cut is a lose-lose situation, right? You're losing your income and you're probably about to lose a bunch of money on your share price as well.
Yeah, it is a lose-lose. It is a lose-lose. So again, we invest in these companies. Of course, Nick, our team here at Wide Moat, we research companies, most companies that have dividends. And not just for the yield. We're not just chasing yield, the next shiny toy, the 12%, the 13%, the 14% yield.
And it's even worse than that, bro. I tell you what, I know I'm on Reddit way more often than I should be. I love looking at the dividend, r/dividends, bunch of income investors sharing ideas. These people in there, they'll post something. There are apparently stocks, there's these leveraged funds, things like that with 20, 30, 40% yields. And they're sitting here asking, hey, how much I'll put into this? To strangers, one, bad idea, right? Don't ask strangers for investment advice. But two, man, just the fact that, there are a lot of people, it's not just one-off. I see this every day. There are people that think, for whatever reason, that you can generate, 40% yields safely. So, I mean, if there's nothing else people get out of this episode, I just want to make it clear, when the interest rates are 4%, there are no 40% safe yields, right? If there's no reason for there to be that wide of a spread. So that's kind of what we really want to drive home today. Please don't, just fall into these traps of just things that if it seems too good to be true, like Brad said, it is, right? 40%, 20%, and even like he said, more than 10%, really anything double digits when the interest rates are this low, just there's a reason why the yields are like that.
Yeah, so today I wanted to provide some real life examples, and these are companies that we've covered over the many years, seeking out, and of course now at Wide Moat Research. So one of the companies I'm going to put up on the screen here is Global Net Lease. Global Net Lease is a net lease REIT. They own about 1,200 properties in about 10 countries. So very diversified portfolio. Back in January of 2018, I wrote a Seeking Alpha article titled "The Raised Nail Gets Hammered." Now, I highlighted in that article that GNL, Global Net Lease, was and still is a sucker yield based upon its elevated payout ratio as well as the riskier external management. We'll touch on that in just a minute. So I explained in that article, quote, when a stock is paying an extraordinarily high dividend combined with an unsustainable business model, there will almost always be a loss of principal. At the time, GNL was yielding around 11.1%. Now, fast forward to during COVID, GNL cut its dividend by 25%, but it didn't stop there. It cut it again on April the 1st of 2024. That was on April Fool's Day. And guess what? It also cut it April Fool's Day of this year. Just a few days ago, they cut it again by 31%.
And that happens a lot, Brad. There's very rarely like just one, cockroach in the cupboard, skeleton in the closet, whatever, saying you want to use, right? If a company's having trouble, it's usually a long-lasting thing. Companies don't want to cut their dividends. Management teams understand that dividend, especially if they're companies that have been growing them for a long time or just paying them for a long time. They know, that's a big part of their company, and no CEO wants to be the person at the helm when the dividend gets cut. So I have to believe most of the time these companies do everything they can to avoid a dividend cut. And when it comes, this likely isn't a one-off thing. Like there are major structural problems at play.
Absolutely. When I see a company cut its dividend, the first thing that I see is this company is not very disciplined in terms of its capital management. Why would you want, that's the last thing you want to do is have a company cut a dividend, because that dividend is a reward to the investor. It's a reward. Hey, the company's profitable. We're making money. So I'm going to give some of that money back to you, the investor. So when you take that away from me, that's not good, especially those retirees or those pre-retirees who are depending on that income to sleep well at night. Now I'm going to throw this other chart up here. This shows GNL's performance since I, called it a sucker yield. You can see it's now 63% compared with Agree Realty, which is one of the direct peers that's up over 45% in that same time period.
And Agree has not cut that dividend. That's just supposed to make it. Agree has done what they're supposed to do. They raise it every year, and that's why they're doing that because they're executing well from a fundamental standpoint. But that just goes to show the companies that don't play these sucker yields do well, and companies that cut their dividends tend to suffer.
Yeah, and I also want to touch on this because I mentioned external management. Gladstone Commercial is externally managed, and I'm not saying every externally managed company is a bad company. However, I'd much prefer an internally managed company versus an external management, because that tells me that management team is aligned with me, the investor. I don't see the management team in an external company. They're out. They've got their hands in multiple pies. They're managing multiple different businesses. So there's a lot of inherent conflicts that exist in this external management structure. So the management team is not fully dedicated to that one business model. And that's another flaw that I see with Gladstone Commercial.
Hey, quickly, Brad, you mentioned payout ratio before. You said those are your two issues, external management and payout ratio high. Can you just explain what that is to anybody that's not aware of what a payout ratio is and why that's, one of the top kind of fundamental metrics that we track for all the companies that we follow?
Sure. So when you look at the company's earnings or what it pays out to investors, that's really the profit that the company generates. Now, in the REIT world, again, it's in my REIT for Dummies book. And by the way, while we're talking about REITs for Dummies, Judy Hunt last week commented on our stream. She's also a subscriber to Wide Moat Daily. Judy, please look us up. We're going to try to get you a copy of REITs for Dummies. And also next week, we'll be looking for comments of you, people who interact in our stream here, right below us here in this video. So we'll be sending you a copy of the book. But back to earnings and dividend safety. So we look for the earnings, and in the REIT sector, we use a term called adjusted funds from operations. And it's simply that, in its simplest form, that's the most purest form of free cash flow that the company pays out before the dividend. So after all expenses, depreciation's factored in, the CapEx costs, capital expenditure costs, leasing fees, everything is taken out of that net income equation and backed into this adjusted funds from operations. So when you have a company, say, that's earning adjusted funds from operations, say $1 per year, and they're paying out in dividends $1.10 per year, that means that they're paying out 10% more in earnings for investors in dividends, which means they're robbing from Peter to pay Paul. They don't have enough money coming in from their business to pay dividends, but yet they're still paying dividends. So that payout ratio is extremely, extremely important.
That would be 110% payout ratio there.
And that's correct. Absolutely. Yeah. And so speaking of that, the next one was Gladstone Commercial. Ticker's good. Ticker's good. In fact, this company they're also in the net lease space. They own about 135 properties in 27 states. Back in 2021, I wrote an article, Seeking Alpha, called It's Too Good to Be True. Again, good is their ticker symbol. Now I'm going to put up this was my article here on the screen, and you can see of all the other analysts, I have the only sell rating there. Everybody's buy. They're all loving this particular company. It was yielding around 7 or 8% at the time. Now in that article, I said, good looks like an appealing REIT with a diversified portfolio of tenants with a high occupancy rate. However, upon closer inspection, we can see the company is handicapped by its cost of capital. Now, I went in to point out they've got a lot of office properties in the portfolio, roughly 48% office in the portfolio. Now, what that triggers to me is when an office tenant moves out of a space, it requires the landlord, in this case the REIT, to pay out more money, more profits to paint the facility, put a new tenant in. These are the CapEx costs. It eats into their earnings power. And recognizing that the office sector has been going down, they got a significant exposure to office, as well as the fact that they had an elevated payout ratio. I'm going to put another chart up here. You can see here the company was paying out about 104% of payout ratio. So it was 4% more of their earnings they were paying in dividends. And then the following year, you can see on the chart, they were paying 111% in their payout ratio. So at the time, again, the yield was around 7.5%. The other thing that I was really concerned about with this company, and I'm concerned with a lot of companies that don't increase their dividend. So not only was the payout ratio elevated at the time, the company had never grown its dividend over about 13 years. And that's a telltale sign to me that there's not a whole lot of alignment with the management team because they're not increasing that dividend as we go. So guess what happened? On January 2023, Gladstone cut its dividend 20.3%. You can see that below there as well. Now, performance, again, Gladstone has underperformed, obviously, because they cut that dividend. I'll show you on this picture here. They're down 22% since I wrote the article. And then Agree Realty, of course, the direct peer, they're up about 12% there in the same time period.
So Brad, you talked about a couple of 104, 110, 111. What's a payout ratio that you're looking for in the REIT space? Obviously it's going to change. I assume there's cell tower REITs, there's net lease REITs, et cetera. But in general, where are you looking, or is there just a red flag, right? Is there a line that once you're above that, obviously if you're above 100%, we don't want that, but 90%, 80%, where is that line that people should be wary of?
That's a great question. Well, first of all, for mortgage REITs, and the next example is mortgage REITs, so we'll save that for next. Mortgage REITs, it's about 100% as they pay out because they own no buildings, they don't have depreciation, it's a pure lending model. But for traditional equity REITs like the two we just mentioned, and based upon the fact that they're in the the net lease sector, and again, net lease means that the tenants pay for most of the taxes, the insurance, most of the time the maintenance. So it's a that's why they call it triple net lease. So for net lease REIT, I would say, the comfort range would be somewhere in the 80 to 85%. You want to keep about a 15% margin of safety, I'll call it, or buffer, to protect that dividend. And that's on average. Now, certain property sectors, you want to have a wider payout ratio. So say, for example, the apartment sector, typically you're going to see those payout ratios maybe in the 70%, 75%, because there's a lot more operational costs. Again, tenants come and go. There's shorter term leases. There are more CapEx costs related to those properties. So again, there's no law that the company has to pay out any percentage. The only law is that exists, again, in 1960s when it went on the book for REITs, is the company must pay out at least 90% of their taxable income, but not their profits. The company can pay out as much profits they want. So to answer your question, Nick, I would say a good healthy range would be 75 to 80%. For net lease REITs, I would say go a little higher because you just don't have as much. They're kind of set and forget 10 or 15 year leases. There's not as much operational cost that goes into the net lease space. Now, the next example I'm going to give you, sucker yield example, is Annaly Capital. Annaly, of course, is a residential mortgage REIT. Now, again, residential mortgage REIT means they don't own properties. They loan money to the housing market. So this is all, kind of a cyclical business. But what's also cyclical is the dividend cut. This company, as you can see here on the screen, is a chronic dividend cutter. They have cut this dividend 1, 2, 3, 4, 5, 6, 7, 8 times over the last 10 years or so. So, they've cut their dividend more than they've grown the dividend. It's a train wreck. And I'm just amazed to see how many people invest in this and even recommend this type of company, knowing the volatility. I mean, yeah, they've averaged dividends somewhere in the 12, 13, 14%. I think right now the yield's somewhere just below 15%.
Yeah, I've looked at it. It's 15% and a market cap of almost 11 billion. So there's a lot of people that own these shares. This isn't like some small cap thing that a few people have been, suckered into. There's a lot of money flowing into this stock.
But this company screams loss of principal, lose money. Look at this next chart I'm going to show you. This is the chart showing the price. And so I went back over, 10 or 15 years. Annaly is down negative 60%. And again, compared to Agree Realty again, which is kind of your proxy for predictable cash flow in the net lease space, is up 254%. So do you want that 12% dividend that, every year that's going to go up and down, and then you're going to lose 60% over this, whatever it is, 15-year period? Or do you want to have Agree Realty that pays like a 4% yield on average today, but they've returned about 254%. Actually, they've grown their share price, so they've returned more than that. So it's not even comparable. Stay away from these companies that can't pay out dividends on a regular basis. And if the company is not even paying out consistent growing their dividends, I really question that, because Nick, you've heard this mantra.
Right? Like if you're a manager, if you're a CEO, or I guess board of directors tend to approve dividend amounts, but if that board of directors isn't confident enough in that business's balance sheet, operations, profits, growth potential, right? That's why we put money at risk in the stock market, for growth. If the board of directors is not confident enough to raise the dividend, like I don't want to own the shares.
Yeah, absolutely. Nick, you've heard me say this. The safest dividend is the one that's just been raised. When a company raises that dividend, it telegraphs the investors, the shareholders, the stakeholders, that this company's safe, and I'm rewarding you for this dividend increase. Now, I'm going to show you 2 examples of companies I really like.
Before you do that, Brad, because Annaly, that is, like you said, that I've on seeking out for throughout the years on Reddit, I see this all over the place. People love this stock. I don't know why. I've never really considered owning it. They talk about, the dividend gets cut, but then the share price corrects and my yield's still 15% like it is now, but that's not good, right? It's not really 15%. Your yield on cost drops when the dividend gets cut. So if you put $100 in, you're not getting, and then they're paying 15 cents a share dividend. It's 15% yield. They cut it to 12 cents a share. Your yield on cost is 12%. They cut it to 10. It's 10%. You're making less and less money. The yield stays the same-ish because that share price is falling. But as an investor, especially a long-term holder, God forbid somebody's held this stock for a decade. If they have, I'm truly sorry. And nothing against the company. I'm sure they're trying their hardest, but it is what it is. That's just horrible. And I see people say, the yield's still 15%. Well, it's not, right? Your money that you invested originally is no longer generating 15% yield.
Well, listen, I've just given you 3 bad examples. I'm going to give you 2 good examples. And these are 2 companies that we've covered Wide Moat Research really since the beginning. First company is called Stag Industrial. You can obviously see with the name Industrial, this is an industrial REIT. They formed just coming out of the Great Recession. You can see on this chart, what's really interesting, is when they first listed back, I think 2009, their payout ratio was a little elevated, about 92%. As I said, not nearly close to that 80%, bogey that I like to see in the REIT space. And I even discussed this with management team. I said, listen, here's what I would recommend. You need to get that payout ratio down, because that's telling me it's not a safe stock. It's not a safe investment. It could cut its dividend. And what I really admire about this management team, again, we've been following them 15 years now, and you can see again on this chart, they've reduced that payout ratio from 92% to 71%. Now, over that same time period, they've simultaneously increased that dividend. So they've been able to do two things really good. They've been able to reduce that payout ratio, which means they've grown the company. They've been able to have enough earnings growth where they can, continue to increase that dividend while also making that payout ratio wider. And that's a pretty significant thing to do. And of course, that to me shows a tremendous shareholder value when the company really is thoughtful. Now, this company also pays out monthly dividends. A lot of retail investors, a lot of our followers like monthly dividends, so they can get paid every single month. So, and if you look at the performance, I'm going to put this chart up from the same time period, roughly since inception through today. The company has generated, they've grown their share price rather 158%. Now, I put here also the couple of sucker yields during that same time period. Good returned negative 27%. That's Gladstone Commercial. And Annaly, the mortgage REIT, residential mortgage REIT, has grown their share price by negative 74%. So which one do you want? You want the company that grows their dividend and also strengthens their payout ratio over that period of time. That's a great example.
And I'm looking at that chart too, and this Stag's not immune to, they're not a perfect company. They're down 25% from their highs in 2021, 2022, when every industrial REIT just took off post-COVID as we're thinking about new supply chains and things like that. So this stock's been, had a big haircut. It's still up triple digits, and it's not a worry for those investors. Even if you bought at the very top of that thing, the fundamentals are rising, the dividends rising. If it were me, I'd kick myself because I'd look at the chart and say, hey, I did probably buy into some FOMO and bought an overvalued company. That's a bummer. But over the long term, if you make a short-term mistake with regard to valuation, which we all do, nobody knows where the stock market's going to go or where an individual company is going to go. Fundamental growth over time will cancel out that mistake. This company's earnings will grow, the dividend will grow, and it's only a matter of time before, even if you bought at the highs, you're going to be okay because, like Brad said, the company's making more profits, they're doing well, they're growing, they're expanding, and in the meantime, they're paying you. So that's the best part about these types of dividend growth stocks to me. If I make a mistake, or if I think the market's being terribly inefficient, if I say, I know I'm right, I think everybody else is wrong. I'm a stubborn, I'm cocky enough to think that a lot, right or wrong. It's if I'm being paid in the meantime while I wait to see ultimately who's right, it's so easy for me to do. You just sit back, collect your dividends, maintain your conviction, and, give yourself 3 years, 5 years, 10 years, and all of a sudden everything will be fine.
Yep. The next example is another industrial REIT. You can see here on the screen called East Group. Now, again, very similar to Stag. The company reduced its payout ratio over the last 10, 15 years from 90%, again, a little higher risk, down to 80%, which is right in line with where I think East Group should be. Once again, I want to show you another chart. This is the dividend chart. The company has increased the dividends over the last decade by around 10% CAGR over the last decade. So that's a pretty solid number, 10% dividend growth. And again, add up all those pieces, you can see the performance. The next chart I'm pulling up here shows the performance. East Group again, this is an industrial REIT, is up 138% over the last few years. Again, let's compare that to the sucker yields. Good Gladstone Commercial is down 19%, Annaly's down 55%, and Global Net Lease is down 73%. So again,
what's East Group yield right now, Brad? Are you looking at a chart?
I'm not looking at it, but I think I'm guessing a 3.5, but you can probably check me.
Yeah, I'm going to Google real quick. 3.7. And then, so that's great. That's fine yield. If you had bought the stock 10 years ago, before all that dividend growth happened, your yield on cost right now is like 8.5%. So that's what we're talking about, right? Annually capital, if the dividend's getting cut every year, your yield on cost is lower than the current yield. If you own a dividend grower and you just hold it, over time, the yield on cost, which is the yield that's on your original investment, if you put $1,000 in, that's the yield on that original $1,000. It grows every year higher and higher and higher. And then that even just compounds further if you reinvest those dividends. So yeah, that's, when you talked about a 10% dividend growth CAGR over a decade, I mean, that's incredible. That dividend's up, I think about, 150, 200% if I'm just quick mental math there. And, that's exactly what we want to see. We talk about sleeping well at night all the time. That is, one, you're making money while you sleep. Literally, you just lay your head on the pillow. This company's generating money across the country. It's paying you. And then every year you're getting a raise. How many people got a 10% raise at work last year? Probably not many. How many people got a 10% raise at work every year throughout the last decade? That's, not many at all, right? But this company did that for its shareholders. So that's the type of asset that we want to own.
Yeah. And as I said, we're in one of the worst, markets, 3 days market cycles we've seen since 1987. But guess what? Dividend income has not decreased over this time for these companies I'm talking about. So again, it's really important to analyze the dividend safety. Nick, do you have a couple other dividend stocks you're recommending today?
Yeah, I'll talk about that. Brad's focused on REITs, and that's his specialty. But I want to, everything he's talking about applies to all the other sectors. I mean, he mentioned AFFO, the adjusted funds from operations. For every other type of stock, generally you're looking at earnings per share, but they're the same. In real estate, you want to take out certain things, and earnings per share doesn't make sense. And that's a tricky thing I see all the time. Realty income, I think if you look at their EPS, their payout ratio is like 300%. Every day on Reddit, I see, hey, how could this be sustainable? And it's like, well, you're looking at the wrong metric. So when you analyze REITs, like Brad said, you look at AFFO. For just about everything else, you look at EPS. So I want to talk about some other things. But before I get to that, I kind of want to circle back to that Munger quote you gave at the beginning about the most important thing about compounding is just don't disrupt it. So you can do that several. You don't have to sell low, right? One thing I want to mention that I think is really important now is everybody is sitting on massive losses today, compared to a month ago, but it's only a loss if you sell it, right? If you believe in that company in a few years, those unrealized losses can very quickly turn into unrealized gains and vice versa. Stocks are risk assets. But, at Wide Moat, we do focus on the highest quality companies, and generally speaking, over the long term, they do well. With that in mind, I looked back at our performance during COVID. We had just started this company in like January of 2020. We didn't know what COVID was going to do or be. Nobody did, I don't think. We had an analyst that was very interested in it. So he was tracking starting from 13 daily cases all the way, 462 cases a day. He was giving us all these updates. It's kind of scary. But we kept doing what we do. We invested, and we did not experience not even a dividend cut. All of the companies that we recommended not only continued to pay their dividends, but every single one, and we're talking, I think there was 25 companies in the portfolio that first year, they all increased their dividend. And that's through a 100-year pandemic that, hopefully we won't see again. There's people going on CNBC saying the world's ending and stuff like that. Well, these companies, they just did what they're supposed to do, right? They make money, and Brad said they returned it as a reward to their shareholders. And that's what tends to happen. So I wanted to show a bad example, kind of like Brad did, of what to look for to prove that not every company just that what he said for REITs goes to the companies, and that these are risk assets. So I wanted to look. Leggett & Platt is a former dividend aristocrat. Up until recently, it had a 52-year dividend increase streak, which is amazing. That's the type of things that we're looking for. Oftentimes, Brad and I start our analysis or our screening process by looking at the streak, right? Like you said, if a company is not raising its dividend, we're not really interested. 52 years, we are always interested in that. However, starting in kind of 2020 and COVID, we saw some pretty significant deterioration in the earnings here. It bounced back in 2021, kind of like everything else did. But then in 2022, you see -18, 2023, -39% EPS. I'm not going to really get into the exact issues here. There's interest rates, there's trade war stuff. There's all sorts of things happening with this company, which is a furniture maker. But to me, I always avoided the stock because I'm sitting here thinking I can go in my garage and make a piece of furniture. I don't think there's that big of a moat around furniture. It's all branding. They all use the same inputs costs, which did go up. Wood got more expensive, coils got more expensive, etc. But we saw this EPS deterioration, and people said this was the highest yielding dividend king before it cut its dividend. So people would ask me, what about Legg? What about Leggett & Platt? Is this the type of company we want to own? The answer was pretty quickly no, because this company is 3 out of 4 years negative EPS, and not just 1-2%. I mean, you could tell something was wrong with the company, and it was an easy no for me. And then lo and behold, it recently cut that dividend. Since it cut the dividend, like the companies Brad said, the REITs, it cut the dividend, I think, from like 46 cents a share to like 5 cents a share. Pretty massive slash. Shares over the last year are down 62%. So just that's what happens, right? The dividend gets cut. 52 years of confidence and trust and all those other, rainbowy great words disappeared immediately. And when that happens, people sold the stock. And for a good example that I want to give, I'm looking down at the screen here, is a company I've been buying as much as I can in the last few days, is Microsoft. Like I said last week, when sell-offs like this happen, markets are scary. I think what people need to do is buy their best ideas. You don't need to chase yields during a time like this. You don't need to do options or crypto or speculate. Now is not the time to speculate. When the markets are crashing, that's the time to buy your highest conviction, highest quality ideas. To me, I don't know if there's a higher quality company in the world than Microsoft. It's one of 2 companies with a AAA credit rating. That's higher than the U.S. government's credit rating. It's not exactly apples to apples. Corporate credit ratings are different than government credit ratings, but it just goes to show they have the lowest borrowing cost in the entire world. They have, they're in the PCs, they're in the hardware, software, cloud computing, cybersecurity, social networking, of course, AI. They own a large chunk of OpenAI, which owns ChatGPT. Pretty much any secular growth trend that's happening in the tech sector, Microsoft has its hand in that cookie jar. And if you look at this chart here, you'll see that growth is showing up in the numbers. Double-digit growth almost every single year. The stock's down big from its highs. I think it's got like a 25-30% haircut. But you know what's not down is that dividend growth. Every year, Microsoft gives you about 10 to 12% dividend growth. And that's what allows me to sleep well at night. Another disruption that's happened with that regard to that Munger term is these tariffs, right? I think we thought about doing an episode on kind of Trump's policy, what is happening, what this means for everybody. I think the fact is one, we don't know. We don't have ears in the Oval Office. It's very confusing. It's going to take some time to play out. So we will obviously dive into that eventually. A lot of people are calling this a pretty big self-inflicted wound by the president. The economy looks strong. The jobs number the other day was great. Profits are good. Consumer sentiments crashed ever since this happened, but prior to that, it was pretty good. So none of that's great, but companies like Microsoft are. So that's the type of thing that I want to own. Tariffs, I think, are probably like a 9 to 15, 16, 18 month issue for us to deal with. I don't think we're going to see a new world order. Maybe we will. Maybe. I don't know. I don't know what the president's trying to achieve. But what I do know is like the AI secular growth trends that are playing out right now, these are 25 to 50 year trends, right? So I'm not going to time this like short-term negotiating tactic that I think the president's trying to employ. I want to capitalize on the fear that that's creating and buy these, 25, 35, 50 year growth stories. Microsoft has just had their 50th birthday. And I don't know what's going to happen over the next 50 years, but I'm betting a lot of my personal money that they're going to be around in another 50 years and they're going to be much larger than they are today.
Yeah, that's great, Nick. And I just posted something on X here just this morning. This too will pass, and I think it's going to pass. A lot of us see fear in the market, and you just got to stay calm and still avoid these speculative companies that we're trying to point out and help you navigate away from those sucker yields and those value traps. We probably ought to do a value trap episode.
Yeah, that's a good one. Yeah, and that's harder. I think sucker yields are easy, right? Honestly, dividend safety is very objective. Does the cash flow cover the dividend? Yes or no? Yeah. You can look at growth. Obviously, there's some things that go into that. Is the balance sheet strong, et cetera? But the reason that we avoid dividend cuts at such a high rate, I think, in my personal portfolio, I've been investing for 15 years. I think I can count the amount of dividend cuts I've experienced on one hand. So everybody makes mistakes, but dividends are easy. Dividend safety, I think, is pretty easy. Valuation's hard though, right? There's so many variables that play into that. That would be a wonderful episode because sometimes you don't know the difference between a value trap and a great value until after the case. But I do think there's things that you can point out that'll, can protect investors in that situation.
Well, I want to remind our audience here. We provide daily, 5 days a week, research for our free. You just type in widemoatdaily.com and you can see our free content 5 days a week. I think it's actually 6 days a week now sometimes. And then, Nick, I think you mentioned our flagship newsletter, Wide Moat letter, comes out today. I believe. Is that right?
Yeah, it does come out this evening. I think, hopefully, or actually, sorry, we're recording this on Monday. It'll be out by the time this is out, but it came out this week. We are very excited about our new pick. Obviously, I can't give that away for free to the public. This is a paid service. This newsletter does cost money. But that, what, Brad, that's what we did. We looked at this crash and we said, what is our highest quality, highest conviction idea, the kind of the safest yield we can think of in the entire market? We had a few ideas to choose from. We picked one for this newsletter here. So I am very excited for our Wide Moat letter subscribers to see this pick. It's been down like everything else in the last few days. We're not focused necessarily on short-term share price here, but I think it's got massive upside. It's got a strong dividend, and the dividend has been growing like 10% a year for a while now. And this management team, we talk about confidence. This management team has guided. They're saying over the next 2 years we're going to do 10% a year. They're willing to look out into the future and tell people this is how good we are, and we're going to reward you for sticking with us.
That's great. Look forward to that. And also next week, Nick and I have talked about our topic for the show next week here at the Wide Moat Show. And I'm excited about this topic because this is something that goes a long way back for me. And that topic is public versus private real estate. Of course, many of you know that I was a real estate developer for almost 3 decades before I got into this new career as a Wall Street writer about 15 years ago. So we're going to talk about investing in both public real estate as well as private real estate, the advantages and disadvantages on both sides. So I hope you'll join us next week. And I want to thank you all for watching this episode of the Wide Moat Show. Nick, it's great to have you on and as well. And I want to remind everyone, drop us some comments. I will be sending out another book, one book a week.
Yeah. Please like and subscribe. And like Brett said, this too shall pass. We'll get through it. Everything will be good eventually. So just stay true to your strategy, and we'll get through this.
And thank you for participating. And have a great week and happy SWAN investing. Thank you for watching this episode of the Wide Moat Show. Don't forget to subscribe and comment below. And for those of you who comment, I'll be sending out one free book every single week for the person who comments in the stream below. If you enjoy what you see, please sign up for the Wide Moat Daily below. Have a great day. Thanks for watching.